channel. Today is Friday, March the 26th of 2021, and I have for the very first time ever, my very first interview with a longtime friend. He is an expert in economics, probably one of the smartest folks that I know. So I would like to introduce to you Mr. Ryan Miller. Ryan, welcome to the channel. If you could you tell us a little bit about yourself, your background, so on and so forth?
Hey, thanks for having me, Tommy. It's a pleasure. I'm no expert, man. I'm just learning like the rest of us. Yeah, so I kind of, I guess, got to this point a little unorthodox than most. I don't have economics or finance degree or really any education on finance or economics or anything like that. Kind of got my foot in the door at a brokerage firm back in like 2014. Kind of was going to go the whole broker, financial advisor route. Wasn't really for me. While I was there, I started trading. Started with stocks a little bit, and then in 2017, I transitioned over to Forex side, the currency side, and I've been mostly trading Forex, a little bit with like commodities, mostly like gold, silver, ever since. So I day trade Forex mostly for a couple hours in the morning, and then after that, my day kind of consists of kind of macro, and then I try to take these big macro concepts and ideas and kind of trade them as well. So instead of day trading certain assets, look to buy or sell them and hold on to positions for days, weeks, maybe months, kind of catch these big kind of macro moves in the market. And then I also write about it. I have my website, Ryan Miller Trading Economics. So it's rmillertradingeconomics.com, where I have a free newsletter. I send out almost on a weekly basis, just different topics, articles, what's going on in the markets, my perspective on things, things like that. And that's kind of where I'm at right now.
And it's a very in-depth perspective. I've read quite a few of them.
Thank you.
You definitely have a great understanding for the market. So I'm going to jump right in. I had a few questions, obviously, which is why we're doing this interview. So we're going to jump right in. With your economic background and being around this business for a very long time, my first question to you is going to be, with our national debt approaching 30 trillion with a T dollars, when, if at any time in the future, days, months, weeks, years, will this be addressed?
Addressed is an interesting question. I suppose it depends what you mean by addressed, but really it addressed as far as when are they going to stop just piling on debt, right? I assume that's the direction.
That's exactly what I'm thinking of. When is it going to stop, and how is it going to stop? Who's going to stop it? When is this going to come to the point where I guess you could say the music stops?
Yeah, so it can't stop, because when it does stop, the system's going to collapse. Here's why. So we have a debt-based economy, right? A debt-based system, right? And what that means is basically first of all, we have a bank-centered system. Now, everyone mainstream likes to believe we have this, central banks. The Fed is central to our system. We have a bank. It's not really the case. We have a bank-centered system. 95+% of money is created and destroyed in the banking system, not by the central bankers. So when you deposit money at a bank, right? The bank can then use that money, that deposit, to then lend against, to create additional money against that deposit. It's called a fractional reserve banking system. Okay, so through those deposits, the bank creates additional money, and when that money is paid back or defaulted on, then that money is destroyed. So that's how 95% of the money, 95+% of the money in our system gets created and destroyed. It's through the bank lending, which is debt. Right, which is debt. Now, debt can be a good thing, right? If you take on debt, and that debt is used to generate an income stream that can then repay interest and principal, then everything's all good, right? Everything's good. But when that debt is not used to generate income stream to then repay interest and principal, that's when we have problems. So take the government, for example. The government takes on a lot of debt, right? The Treasury issues bonds at auction. The primary dealers, the banks, They buy those bonds at auction. They give the Treasury cash. The government then uses that cash to fund liabilities, say military expenses, Social Security, things like that. So when government takes on debt and then they're using that money to fund Social Security, to pay out Social Security, well, that's not generating income, right? So now they're going to have to take, so that hurts their cash flow, right? Because now they're not generating income stream to repay interest and principal, so they have to find cash somewhere else to repay it, or what they do is they take on more debt, right? So, and that's why the system has to continually grow, because we're constantly taking on debt to fund transactions and liabilities. So if the system's not growing, we have problems. So the second the system stops growing, it's going to collapse.
Okay? I mean, my big concern is, I mean, look who's buying these bonds, right? China is buying all of these, not all of them, but a good portion of these bonds that at some point in time, I mean, China has a lot of patience, unlike the United States. They can just wait and wait and wait and wait. But my question is, what's going to happen when the U.S. has to pay this back? You know what I mean? It doesn't make sense. It's $30 trillion. 10 trillion of this was added over the course of the past, 2.5 years?
Yeah, and well, that's the thing. That's why they're just going to keep piling on the debt. So when you have a debt-based system, and as it continues to grow, and as your debt gets bigger and bigger, right? Each time you take on more debt, you now need more. You now need more dollars to service that debt, right? So now you have less money to spend, to put towards investment, production, things like that. So that's why we're starting to see, as the debt grows, you now have to grow it at a faster rate to keep up with your liabilities and transactions and things of that nature. So they're forced to they've dug themselves in such a deep hole that they're forced to just keep taking on debt, printing money, so to speak, and kind of keep the ball rolling as long as they can. Now, you mentioned like kind of 30 trillion. That's a large number. It's not so much the level of debt as it is the debt to GDP ratio.
Right.
So let's say we have $30 trillion in debt like we do, but our GDP is 100 trillion. Well, now our debt to GDP is only 30%. It's not that big of a deal, right? But our GDP is about 20 trillion. So our debt to GDP is about 130%. So we have more debt than basically our economy produces in goods and services, is valued at, really. All right. So there's a lot of and once you hit a certain point in debt to GDP, it becomes a drag on the economy. I think we're going to get into that a little bit later, so I'll save the rest of that. But yeah.
So I guess this kind of rolls into my second question.
Okay.
With the U.S. dollar, which we all know is a fiat currency, it's losing its value and buying power on a daily basis. In your opinion, will it remain the world reserve currency, or will we return to the gold standard, the digital currency, or some other country's fiat currency?
Yeah, so short answer, dollar is not going anywhere anytime soon. So reason being, what is a reserve currency? That's what's important. That's what people need to understand. Like, what is the importance of a reserve currency? I'm going to give you an analogy. I stole this from somebody else, but explains it very well. This guy, pretty well known in the macro world, Chris McIntosh. So think of like the English language. You can go anywhere around the world and a lot of people speak English. Right? Yes, me, I don't speak any other language. Right? I just speak English, but I can go to Europe, I can go to other countries and interact with them and check into my hotel, order food, because so many people speak English, right? English allows me to transact and communicate with different cultures, different economies, different primary language speaking countries, because English language is kind of that intermediary. It's kind of that middleman, right? So it connects everybody kind of globally, right? That's what the U.S. dollar does, right? It connects the world globally. It allows intricate systems, it allows very different economic systems to interact and communicate with one another, right? Because they're doing so in dollars. Okay, so instead of one country worrying about, okay, I have to exchange my local currency for their local currency. I can just buy and sell in dollars. I no longer have to worry about exchange rate risk, right? What is the exchange rate I'm going to get when I have to convert my dollars to their dollars and vice versa? Now, there's times where local currencies need to be exchanged for dollars, but if you have dollars, okay, now I can buy goods and services in dollars. I can also accept payment in dollars because I know that someone else is going to accept payment in
Right.
dollars. So it makes interacting very easy. And the US dollar is very deeply rooted in the system, right? Everyone talks about like Bitcoin's network effect, right? The dollar's network effect is the greatest network effect we've ever seen, or
Right.
at least in modern time. It's global. Everybody wants dollars, is willing to accept dollars. About half of global trade is denominated in US dollars. About 40% of global debt is denominated in US dollars. About 90% of FX, foreign exchange transactions, are denominated in US dollars. There are tens of trillions of contracts globally that are denominated in US dollars. So you can't just say like, hey, let's switch to something else. Let's switch to the euro. You'd have to reprice those contracts. There has to be certain like the dollar has such deep liquidity throughout the world. No other currency has it. You can't just kind of switch to something else overnight, right?
Well, I guess one of my questions, I guess, also on top of this is the U.S. dollar obviously has been the world reserve currency for as long as we can remember, but that's also, in my opinion, because the U.S. has the world's largest economy, right? And what happens in 5, 10, 20 years when the U.S. economy is now number 2 to China, number 2 to maybe another up-and-coming country or the European Union or whatever the case may be. But is our world reserve currency status because we are the largest economy in the world?
So that's how it started. That's a good question. So after World War II, so you can argue we had the reserve currency since post World War I, but it really became official, I guess you could say, at Bretton Woods, 1945, 46, 45, right, post World War II. Yeah. And yeah, we were the largest economy. Our GDP made up about 40% of global. U.S. made up about 40% of global GDP. Now it's, depending on how you measure it, it could be around 20%, under 20%. So it's decreased significantly. And China is like right there with us, right, as far as global power. So in the I don't want to get too deep into this. It's kind of complex, but in the 1950s, another system actually kind of developed in the shadows. It's called the euro-dollar market, the euro-dollar system.
Okay.
And what that is not to get confused with euros. It has nothing to do with the euro. So because the euro didn't become a currency until like 1999, 2000. So prior to that, any domestic dollar that found its way outside of the domestic economy in an offshore bank, so let's say a US dollar found its way into a London bank, it would be called a euro dollar, right? Just like a Japanese yen was outside of Japan and be called a euro yen. Right. Okay, so this whole market kind of developed in the 1950s, and there's different reasons why and exactly how it started, but it developed in the 1950s, and it really kind of took off in the 1960s and 70s because we were on that kind of gold standard, and there's just not enough gold to go around, right? And as you said,
it's got an $8 trillion market cap.
Yeah, that's not enough. It's not enough, right? There's tens of trillions of dollars out there, much larger. Just in the domestic economy, there's like $20 trillion.
But right? Ryan, let me ask you. When we were on the gold standard, President Nixon took us off it back, I believe it was 1974 when he ended the gold standard.
Yeah, 71.
Yeah. I'm sorry, 71, excuse me. When we were on the gold standard, wasn't it a check to the dollar that you couldn't spend more than what the reserve value of gold was against the dollar?
Yeah, to an extent. I think even going back to like post-World War I, gold only really had to back about 40% of the dollars in existence. So it wasn't like a one-to-one backing. And as time went on and there became more global need for dollars, that kind of shrunk the as far as how much gold was backing. It was like 40%, and it shrunk because there was not enough gold to fund the world with dollars, and that's why this euro dollar market came about. And what this euro dollar market is, it's a bank-centered market. And like I said, without getting too in depth in it, because it can get pretty complex, what banks do is they basically exchange different assets and liability. It's an offshore market, right? So the Fed or any other U.S. government or authority has zero influence or authority over the Eurodollar market. It's bank-centered, and what they do is they exchange different liabilities and assets in very kind of sometimes complex ways that oftentimes doesn't even show up on a balance sheet, and they create these euro dollars, which are technically dollars. And so that's how, because the U.S. was no longer big enough to support the world with dollars, that's how the globe got the dollars that it needed, was through this euro dollar market, and it's grown and it's grown and it's grown. Now, estimates as at the end of 2019 by the BIS, which is the Bank for International Settlements, had euro dollar debt, so dollar denominated debt outside of the U.S. at like 13 trillion, I think is an extremely conservative estimate. There's other estimates that put it at 20, 30 trillion. There's a lot of people who think it's even a lot bigger than that. So basically what I'm trying to get at is the world is indebted in dollars because of how much debt there is. So when you have debt denominated in a currency, it's demand for that currency because you need dollars, that currency, in this case dollars, to service that debt. So the world is overly indebted in dollars because there's tens of trillions of dollars in debt, not only domestically, but outside of the U.S.
So you roll right into my next question.
Okay.
Many experts, I'll use Peter Schiff as an example. I personally think he's one of the smartest people in the world. He and others are predicting a global economic crisis in the very near future in the form of hyperinflation. Do you see this as an accurate prediction? And if so, what stages do you predict the next crisis to take place?
Yeah, Peter Schiff is a smart guy. He has the opposing view to my dollar view. He thinks the dollar is kind of dead, as do many. That's kind of the consensus, right? Dollar is dead. So I think to answer your question, I think yes and no. I think hyperinflation is the end game, but I don't think we're there yet. I think we're going to see more deflation first before we see hyperinflation. The reason why, this will go back to kind of the first question when I was talking about how much the debt to GDP ratio. So I want to talk just a minute or two about the deflationary forces that are out there. So debt to GDP. So there's a lot of studies that show that once debt to GDP hits about, so first, before we get there, first, when you take on debt initially, there's a bump in GDP. Now, Dr. Lacey Hunt, brilliant economist, probably my favorite economist, modern day at least. This is part of his framework. He talks about this a lot. So once debt to GDP hits about 90, I'm sorry, I'm jumping ahead again. So debt, you take on debt and you get a boost in GDP. It's kind of linear, right? They're rising together. Once debt to GDP hits about 90%, it becomes nonlinear, meaning debt continues to rise and GDP starts to kind of flatten out, right? And once you continue to overuse debt, debt continues going up and GDP starts to turn down, right? It becomes a drag on the economy. And what takes place is something called the law of diminishing returns, which states that each dollar of debt, the more debt you take on, each dollar of debt becomes less and less productive. So if you go to post-World War II, every dollar of debt that the U.S. took on created like $1.30 in GDP, right? It was productive. You go back about 10 years or so, 2008, 2009, $1 of debt generated about 45 cents in GDP. It diminished a lot.
Yeah.
Now, $1 of debt, I don't know the exact number, but it's under 40 cents. It's closer to the 30-cent mark. So $1 of debt is producing only like 30, maybe 35 cents in GDP. So each dollar in debt is producing less and less because more, like I said before, more debt you take on, the more dollars you now need to service that debt. So the less dollars you have for investment and production and spending. And then the more debt you take on, that you need these dollars to fund your liabilities, to service debt. It's not going towards the real economy, right? It's not going towards production to produce goods and services. So it becomes a drag on the economy. So we have this huge deflationary force, which is the overuse of debt out there, right? A couple other real quick deflationary forces out there. We have an aging demographics. here in the United States, we're getting older. And as we get older, obviously, it means less workers. And as people get older, they generally spend less, which isn't as good for the economy. We have a declining labor market. So if you look at the labor force participation rate, which is the size of the labor market, how many workers are in the labor market, from I think like the ages of 15 to like 64. It's been declining since 2000, and since 2007, 2008, the global financial crisis destroyed a lot of jobs, and it's been on an even steeper decline. So that's another deflationary force that's out there. And then we have bank credit, right? Bank credit has been contracting. Banks are not lending the same way they used to before 2007 and
I wonder why.
2008. Yeah. And bank lending right now is the tightest it's ever been since 2008. So there's a lot of deflationary forces out there. So I see more deflation first. Now, there is a potential game changer before maybe we see deflation. A year ago, March 2020, after we had that sell-off, we had all this stimulus hit the market. We had these like PPP loans, right? These government guaranteed loans. So if you look at bank lending, you'd see in like March and April, you see this big spike in lending, right? Because the loans were guaranteed by the government, right? Yeah.
Free money to some people, right?
Exactly. But since then, since I think May, credit has contracted every month on a month-over-month basis, right? Banks do not want to lend. So right now, that's been a one-off. This government guaranteed loans have been a one-off. If the government decides to start making these start doing it more frequently, a more permanent thing, right? That could be a way to you get this, kind of runaway inflation pretty quickly. But until then, I just don't think there's been enough pain. I think all the deflationary forces out there, I think the inflationary pressures we're seeing in the market right now are going to roll over. We're going to get another deflationary shock, more pain. And then when that happens, the authorities are going to have enough. Then they're going to come in with their more PPP type loans. They're going to come in, potentially go down the MMT, modern monetary theory path, where they basically, they're going to have to rewrite their Federal Reserve Act for this, but they're going to make bank reserves legal tender. And then when that happens, you'll get your inflation and your potentially hyperinflation endgame. But I just don't think we're there yet. I think that's kind of years down.
That's a bold prediction. Yeah. It's a bold prediction. So speaking of 2008 and crises, much like in 2000, 2001, the dot-com bubble, September 11, 2008, and currently 2020 to 2021, the Federal Reserve has lowered interest rates to 0%, in the process paving the way for the next financial crisis, right? So the dot-com bubble burst, Fed lowered interest rates to 0. The housing crisis or the mortgage-backed securities crisis, the Fed lowered rates to 0. COVID-19 hit, Fed lowered rates to 0. Chairman Powell foresees rates staying at 0% for the long-term future. How does this affect the average American, and what will be the outcome of this?
Yeah, I mean, the whole point with the ZIRP, the zero interest rate policy, was to boost the economy, right? Stimulate the economy, but that hasn't worked very well. Right. 2009 through 2019 was the worst growth period in history, right? So it hasn't worked. And then when you combine this zero interest rate policy with QE, right, the kind of illusion of QE, this money printing, which probably don't have time for, what happens?
QE is quantitative easing for my viewers out there.
Yes, what happens is it kind of creates these bubbles in financial assets. So despite what the mainstream kind of thinks, low rates is actually a sign that money is tight, not that money is loose. When there's low interest rates, it means money is tight. And we can, like I said, we could just look at the bank lending, right? Lending's been contracting. Lending standards are tight, right?
Right. If I can jump in just real quick on that statement, by you saying money is tight. At the same time that we're saying that money is tight, we're watching home buyers going 20, 30, 40, 50,000 over asking price. Home sales reached record highs. I believe the report came out, about a month and a half ago. I mean, it's since tapered off over the course of the past 2 months, but banks are lending that money to home buyers. I mean,
Yeah.
I'm not saying they have FICOs of 450, but you
No,
get
no, of course. So here's the thing: when interest rates are low, money is tight, lending standards kind of they tighten up. Though that doesn't mean no one can borrow, right? Those that can borrow are generally the people who are not generally, or the people who are credit worthy, and oftentimes those are wealthier individuals. And wealthier individuals, they own the majority of financial
right.
assets, real estate, stocks. So when you have low interest rates, it's going to incentivize people to borrow, and you have this kind of illusion of QE that the Fed's got your back. It's going to bump up prices. Things aren't going to turn to the downside. The Fed has your back. It's going to incentivize people, those who can borrow, to borrow. And what they're doing is that money is funneling into, they're borrowing, it's funneling into stocks, into housing. Right. So that's why we're seeing housing and stock prices going kind of through the roof. It's because you have the low interest rate environment. You have this kind of QE. Those that can borrow are the wealthy, and they're the ones that own the majority of financial assets. And the rich have gotten richer because of it. Since global financial crisis, even in the past year, the rich have gotten richer. It's widened the wealth gap. So those who, the top 1% or so have gotten richer, and the bottom majority have don't own as much. That gap has widened, and it's created a lot of civil unrest and political unrest. Right.
So, I mean, we saw a lot of people fleeing from New York during the pandemic to New Jersey. We saw people from New Jersey, New York go down to Florida, to find these, I guess, tax safe havens, essentially. Could you just talk for a minute or two about, the people fleeing New York, fleeing New Jersey to, states like Tennessee, Florida that, are, Florida has no state income tax, right? So some people see value in that. Could you just talk about that for a little bit of why people are fleeing?
Yeah, I mean, we'd have to really think for this one. Real estate, that kind of, it's definitely not my area of expertise, but generally we've seen people moving out of cities. Cities are more expensive than urban or rural areas, right? And especially when COVID hit, right, because we saw this sharp increase in housing prices. What people don't talk about, we've actually had a decline in rents, right? So we're not seeing money kind of hit the broad market, right? Increased housing prices, decrease in rents, but people like, why am I going to stay in the city if I can't live the city life, right? All the businesses, everything's kind of been shut down. People are moving out. Not just people, businesses are moving out of the city, right? This pandemic has really changed a lot of industries, right? Me and you, instead of talking in person, we're talking over Skype. People are using Zoom and whatever it is. Businesses are realizing they don't need as much office space anymore. They don't need to fly salesmen out across the country for sales meetings. They could do it over the internet. Why am I spending all this money for real estate, for travel, things like that, when I could just do things online? So people are downsizing. People are getting out of the more expensive areas, and that's why I think we've seen a lot of home prices kind of jump. And I'm sure there's a lot more to it, but that's not really my.
Well, we could get into that in another interview. So my final question for you, being that you're a gold guy, Forex guy.
I like to trade gold. I'm not a gold bug. Let's just
so here's my final question to you: gold or Bitcoin?
Oh man. Bitcoiners, they blow up their own heads enough. I'd hate to say Bitcoin, but yeah, I think going forward, especially with we get into that kind of runaway inflation scenario, I think both will perform well. Bitcoin's obviously outperformed pretty much everything. Definitely outperformed gold, and I see in the next several years or so, I think both will perform well, especially once we start getting inflation. I think both will perform well, but I think Bitcoin will outperform.
There's some big bank analysts out there that are saying gold may quadruple before the end of the decade. Do you see that as a potential reality?
I think I mean, quadruple, a double in price, triple in price. I don't know exactly, but I think over the next decade when we really start to get inflation, and the fiat currency system really starts to take a nosedive, I think, I think gold could double, triple, quadruple in price, and then if that's happening, Bitcoin's, going somewhere in the six figures for sure. Yeah.
That's big for some people that bought it at the very bottom and held on to it, right? So,
Yeah.
Well, Ryan, listen, I really appreciate you coming on to the channel today. I think my viewers are going to get a ton of value from this interview. So I want to say thank you, and I hope that we could have you back real soon to go over some other topics, including Forex and maybe some strategies and things like that. We could potentially dedicate a whole video to that to get your expertise in the matter. So
yeah, we can do that. It was a pleasure, Tommy.
I really appreciate it. Thank you so much, Ryan.
Yeah, no problem.
All right. Thank you.